You are listening to Keystone's Stock Talk Show, episode 294. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to chat with you again this week. Get our spring on-demand webinar today, including a new profitable picks and shovels buy to participate in the gold boom, trading at around $1.50 below its true value. This week, we're going to kick off the festivities with a look at the U.S. bond market from Brett. It's driven by Trump tariffs. Whiplash had its worst week in decades, with 10-year yields moving as much as 72 basis points during the week. The biggest increase in yields since 2001. Brett details the action and lets viewers know the implications. I will continue with a small snippet from that webinar that we talked about above on Orphan stocks, the opportunity, and give one real example here. In our Your Stock Our Take segment, Aaron answers a viewer question on Karman, Space, and Defense, KRMN, on the New York Stock Exchange, a leader in rapid design, development, and production of next-generation technologies to combat near-peer nation-state threats, focused on critical integrated systems for the hypersonic missile defense, UAV, and space sectors. Aaron takes a look at the company's recently reported fiscal year 2024 results, the growth, and current valuations. Brennan answers a viewer question on ADF Group, symbol DRX on the TSX, a North American leader in the design and engineering of connections, fabrication, including the application of industrial coatings and installation of complex steel structures for the non-residential infrastructure sector. Last week, the stock dropped 33% following its fiscal year 2025 numbers and its fiscal year 2026 outlook, which reported tariffs will impact margins. Brennan updates our thoughts on the stock following our last review, which we called to avoid the business near term. Now let's get to the show. My co-host, Aaron Dunn, he's here again. We have the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Doing good.
Great. Yeah, always chaos in these markets, of course. Never a shortage of news to talk about.
No doubt.
No, without a doubt. And myself and Brennan are prepping to go to the Planet Micro next week. Interview about 20 companies. Should be an interesting conference. Always get the feel of the U.S. Businesses, the U.S. investors down there, and how they feel about how they're treating Canada right now, generally speaking. We'll see if we get a lot of stories like we did in California. Should be interesting to see.
Yeah, we'll see.
Yeah. Well, I'm glad to hear that Brett is doing a segment on the bond market, because I thought that was something that is not talked about as much as it should be, given its influence. Like most of the time, the media and people are focused on what's happening with the stock market, the Dow, the NASDAQ, up and down. But the bond market is many times the size, far more powerful. And in many ways, this is kind of like the stock of the U.S. government, right? Because that's where the U.S. treasuries are. So I'll let Brett talk about it, but I'm glad to hear that we're going to dive into that.
I kind of stumbled in the opening because it's the biggest increase in yields, and I was looking, and is that a typo? It's not 2020 something. It's 2001. Yeah. That's why I kind of said, really? I'm like, oh yeah, that's crazy.
And that was just the 10-year. The 30-year was actually 1982.
Wow,
yeah.
That's crazy.
Yeah. Increase.
Mm-hmm. Yeah.
Yeah, Brett and I were talking about it lots last week because, I mean, obviously I want to buy a house eventually, and I'm trying to stay a little bit more liquid. So I've got bonds, and we were just talking about our own portfolios and whatnot. So yeah, I'm glad as well that Brett is going to be taking a look at it. It's interesting.
How's the market out there in Saskatoon?
Like housing market, I'd say that it's still relatively strong. You know, we're still basically at all-time highs. I think Brett would probably say the same about Calgary. The housing market. I'm assuming it's a little bit softer.
I think we came off a bit. Yeah.
Yeah, Calgary,
but yeah.
I think, has come off a bit. I know it has come off here.
Yeah.
I mean, not
a ton.
Massively. And here is Vancouver, for those who don't know where me and Vancouver are. Just here. Everybody should know, right? Yeah.
Your house.
Yeah, around my house. Yeah. But do we want to just get right to the poll question? Because we got a lot to go through today. And we can always talk about the bond market after Brett's segment, which will lead off right after this poll question.
Yeah, exactly. So the poll question was just with U.S. Treasuries being normally that safe haven asset, and during times of volatility, it's normally a safe haven asset during times of volatility, and that just doesn't seem to be the case right now over the past week. So the question is, are we going to see U.S. yields? I just put yields in general, not a particular tenure. Are they going to continue to rise? 53% of our viewers said yields are going to continue to rise. 22% said roughly the same. And 25% said they are going to fall. And of course, for the people who are really just coming into finance or bond markets in general, bond prices are inverse to yields. So if yields go up, bond prices are coming down. Mm-hmm. And I guess just get right into my segment from there, because it all is related from that.
Yeah, I guess I can also say, just like as you're pulling up your screen here, I did vote, U.S. yields are going to fall. The only reason I'm saying that is because I know that there is a lot of uncertainty about, near-term inflation with tariffs. But I think, again, it all comes down to the underlying growth numbers. But I'll let you take it away, Brett.
Yeah, so this has all been on the back of really the Trump tariff whiplash. Just no really plan set in motion or set plan. No one really knows what's going on. And day by a change is over the weekend, it changed 2 or 3 times what was going to get tariffed in China. And we've just been seeing that since Liberation Day, in quotations, I'm going to put that. But the bond market, which we want to focus on here, has just had the worst week in decades, with 10-year yields moving as much as 72 basis points. That's 0.72%, 100 basis points in the percent. The biggest increase in 10-year yield since 2001. The 30-year had its worst week since 1982. So decades long for a weekly change. Obviously, it's a small period of time, and it depends on longer-term trends, but that is a shock to the market. And bond markets in general, especially the U.S. Treasury market, or really any developed markets, so Canada, Europe, and so on, don't move quick. It is like a train. It takes a lot to change the direction it's going. So when it moves quick, it is very unusual, and it is not anywhere normally near this volatile. The U.S. has somewhere around $28.6 trillion in outstanding treasuries as it uses it to fund its ongoing deficits, which has had since the Clinton government and even before that, but that was the last time they ran a surplus. And that's funded by foreign governments, private investors, holding a large portion of that outstanding amount, as it's been the world's reserve currency since World War II, the Bretton Woods Agreement. So volatility like this in the U.S. bond market is really not even just a worrying sign within the U.S., but globally, because it can really shift the structure in U.S. or in global financial markets, not just in the U.S. Up here, I have the U.S. yield curve, and this is just the shift between Trump's Liberation Day on April 2nd, and you can see the long until last Friday, April 11th. And you can see the long end of the curve is noticeably steepened, with a short end remaining relatively the same, as that really just depends on whatever the interest rate is set by the central bank for whatever country it may be, in the US in this case. Trump does not want higher interest rates, with him continuously pressuring the Fed to lower interest rates aggressively. And further, and this is probably what shook him up last week, and actually had a bit of a reverse course in his tariff policy. He even stated that markets were getting yippy when he announced that pull back to the 10% baseline tariffs on all but China, and that the bond market is tricky in the same speech. Take that as you will, but he's clearly, and his White House, his team behind him, is paying attention to the bond market, at least to some degree, and it's likely, in my opinion, influencing policy at this time. But still, overall, I will mention there's still higher tariffs than there is a month ago, just less than what we were initially going to see based on what I will just plainly say was poorly calculated tariff table that he showed on Liberation Day. Why does that shift in U.S. yields matters so much. First, the US dollar as a whole, and by extension, US treasuries, because that's how you'd want to hold your US dollars if you do need it. You want to get paid to hold your US dollars. It is the world reserve currency, and has long been that safe haven asset when there's volatile markets. And we just haven't seen that over the past week, as the stock market has had absurdly high volatility, with VIX just spiking way up, and some of the biggest increases and decreases in the stock market that we've seen in years, if not decades, depending on what time scale you are using. Normally, a flight to the US dollar and treasuries occur during any really market instability. People saw it as safe haven asset, but just the opposite has happened this time, which is extremely abnormal. We can see using DXY, which is the index of the dollar effectively. It's a basket of currencies that the US trades against, very heavily weighted towards the euro. It's like 56%, but then you got the Canadian dollar, the Australian dollar, and so on in it as well. But we can see the US dollar index has fallen sharply over the same time period. And as well up there, I have the Canadian dollar, and you can see the Canadian dollar strengthened during that time. DXY has fallen about 4% since April 2nd, which is a big move for currencies that are from a developed market like the US. This means there's been a selling off of US dollars, not buying like you would normally see. So now with higher yields in the bond market and a weaker US dollars, any entity with US denominated debt, whether US or internationally, will need to raise at a higher rate. Whether it's corporate debt, U.S. mortgage, people who need to finance in general, just won't be happen if they need to raise in U.S. dollars. International holders of the U.S. debt, so on the other side of the coin, will be very unhappy as they've seen their bond prices decrease, as well as exchange rate hurt them as well during this period, which can have some run-on financial effects. It's really a double whammy for anyone who is holding U.S. bonds and their base currency is different. So if you're Canadian, European, and so on, you got hit by a double whammy there. And further, what I will mention here is it may impact companies, well, will likely impact companies who receive this very common US dollars as revenue, but have costs in other currencies, which is common for things like commodities, but as many other industries, and just really depends on the company and where their end markets are. What that will happen is they'll have lower revenue and they'll have margin compression because their costs will stay roughly the same, but lower revenues. The magnitude of this change wasn't the largest, but the time period which it has occurred over is fast. So you'll likely just see headwinds, assuming things stay relatively similar going forward. But if you keep seeing the decline in the US dollar, that would specifically hurt companies which do have US denominated revenues and external costs or foreign currency costs from this perspective. Further, this will impact how we just look at assets trade against the US dollar in general. I want to just highlight this. Because last week we saw gold surge. It was making some headlines, gold being seen as safe haven asset. But it wasn't, a large part of this wasn't just gold strengthening. It's because we measure gold against the US dollar weakening in this case, where the change in gold's price in other currencies just wasn't as big. I bring this up since if we do see a continued debasement or devaluation of the US dollar, we will see other prices rise in respect to the US dollar, but maybe not in other currencies, maybe not as much. The fluctuations will be different compared to the US dollar if the US dollar on its own keeps weakening. And since everything really that you look at indexes on international or commodities is based in the US dollar, you need to pay attention to that if you are not based in the US or use your US dollars primarily. So what is causing the yields to actually rise? Well, we know the initial push, the really trigger of it all was Trump's tariffs. That's obvious. That's not a surprise. But for bond prices to fall and yields to rise, someone needs to be selling. And that really has an array of speculation. I've seen all sorts of theories online. There's no clear smoking gun by any means. It's likely multiple things and multiple aspects going on at once. Because like I've said, there's $28.6 trillion in U.S. outstanding debt, with at least $8.5 trillion held by foreign entities. So that can be central banks, that can be private citizens, and that's only for the amounts actually held in US-based broker-dealers. So that's a minimum. There is more foreign exposure past here since you can't track it as easily. So the actual amount will be likely quite a bit higher. And naturally, central banks are major holders of US debt. So if they are selling, they're going to be selling a lot. They hold large amounts of it. And if they are selling, it would create massive pressure. And that's why people are really speculating. I've seen a whole wide array of speculation, a big one being Japan, which is the largest holder of US debt, to Canada, to China, to Europe. Effectively, any central bank which could have some reason, whether it's them wanting to weaken the US dollar in Canada's case or Japan case, because they're having this trade war to a degree. In China, it doesn't make as much sense. I'm not going to get into that, why they would. but there's been speculation about central banks just selling in general. And really, this is due to how spread out the US dollar is we don't know what's causing it. I purposely left this pie graph up with all the different labels just to show how widespread the US dollar is for even major holdings for countries. And it's just completely widespread. That's why it is the world reserve currency, or it is the reserve currency because of that. And this is actually, I'm going to tie this into quickly the tariffs. This brief point is part of the reason the US dollar is the reserve currency is because they have this constant trade deficit. They are pushing US dollars out in the world to buy foreign goods. That's what that life cycle of a US dollar does to make it a reserve currency. A trade deficit has supported that aspect. But another popular speculation of why there's been this shift in yields has been deleveraging of basis trades, which are normally very highly leveraged, as it's just a very tiny little spread between futures and US bonds. Sometimes the futures are made into swaps, of course, which naturally converge over time. So as time goes on, the spread narrows, and then it's highly leveraged. So it might only be 5 basis points, but if you leverage up that 50 times, that's 2.5% over whatever time period it may be. And since the bond market is very volatile, it's harder to maintain that level of leverage. So some of the speculation is deleveraging just from high volatility. A couple other factors I've just seen brought up, just more general, is inflation expectations are higher, which does make sense when you see the long end of the curve go higher. That the length of the bond will be impacted more if inflation's higher over the long term. And investors want to be compensated for it. So the yield, real yield, so once you subtract the inflation, is similar to what it was before. And then just general deleveraging or hedge funds deleveraging any trades. The market was so volatile, you're going to have shorts get squeezed out, you're going to have longs squeezed out. Anyone with leverage could have got squeezed over the past week in reality if you were too leveraged, or it can just be general de-risking as well. And perhaps the most interesting long-term structural thing, which I will bring up, is just there's been more talk about just general loss in the US dollar as a safe haven. And really, is this shift in US yields and policy, the canary in the coal mine sort for the end of US hegemony? Is that the case? If you asked most people a year ago, we were talking about BRICS, it wasn't really that big of a deal. But now more and more people are talking about that. Well, I don't believe that's the case this time. The fact that this is even being questioned on a broad scale, just not pure speculation type of thing, it does show that there's been really a global shift in perception about the US and using the US dollar since the Trump tariff onslaught and its policy changes. If we do start to see continuous outflows from US assets, whether treasuries, but just the dollar in general, that would have a stronger indication of global structural change. We haven't seen that this time. It's been a week. That's a very short period of time for something like this. It would play over years, if not decades, for something like this. But obviously that timescale could change very quickly, depending on the decision of one man, Donald Trump, over the coming days and months ahead. Anything could change with him. With some commentary being around some sort of Mar-a-Lago Accords to restructure finances similar to the Plaza Accords in 1985, which depreciated the US dollar to make them somewhat more competitive on the world stage. Are we going to see something like that? Generally, though, it will be something interesting to watch to see how the market continues to react, what will occur, and really, are we going to be looking back on this years to come? Is it going to be in textbooks, or is this just going to be a completely forgotten blip in the market like so many other things end up being? Yeah, I'll open up to you guys there.
Yeah, well done. I mean, and again, like that's then, just the thing is, we don't know what the smoking gun is. Even I was speaking with one of my friends, AJ, and he was, instantly Japan selling treasuries. And I said to him, I was like, as far as I know, that's a rumor.
That was the first one I saw as well, and I think it was one of the more popular ones.
If AJ says this, then I think we need to listen.
Yeah. Can we bring AJ on soon?
No, let's not bring AJ on. So,
that's too bad.
But
we'll
yeah,
okay. So.
It just is very interesting what's going on, and like Brett said, is this just a blip? Everybody's saying, oh no, the bond or the treasuries, aren't a safe haven asset anymore. It's been a week. Does it continue to be a safe haven asset over the next year, 2 years? We'll see. Is it just this little blip? Is it this basis trade being, unwound by a lot of hedge funds and whatnot? Because again, typically you're buying treasuries, shorting the futures or treasury futures, and then if you're trying to unwind that trade, you got to sell treasuries. And again, like Brett was saying, you're just working with like just small little fractions, so you have to use a lot of leverage to make money or make a lot of money with these trades. So again, we'll see. It's very interesting, but I 100% agree that I think the bond yield increasing is influencing Donald Trump's policy. What did he say? The beautiful bond market, the beautiful bond market. He said something along those lines. I think it was the Thursday or the Wednesday when he put the 90 day pause there. But I know that everybody's saying, oh, he's not worrying about the stock market. Well, that might be the case. He certainly, has to worry about the bond market.
Yeah, and I mean, we've talked about this before about how in the past when he's put tariffs forth, once he's felt a consequence, he's generally backed down off of them. And it seemed at first with the market going down or all the volatility in the market, like he was really digging his heels in and claiming that he didn't really care. But then when the bond market starts to falter, that's a whole different story. So it's wasn't necessarily what I was hearing people predict in terms of what would be the thing, but I mean it does make perfect sense given the size and importance of the bond market. I mean, if you just look at, as I said in the intro, it's very much kind of like the stock of the U.S. government, right? I mean, most of this is U.S. treasuries, and I think the figure that I've heard is roughly around 250 to 300 billion would be the annual increase on average for every 1% increase in interest rates would be the annual increase in the interest expense on U.S. federal debt on average. Now, not all of this would roll over in year one, so it wouldn't necessarily be the year one expense, but that would be basically the average or what it would eventually transition into. So that's a major direct consideration of the U.S. government that you can't just ignore, obviously, as it interferes with all of your other plans for how you're arranging your budget.
For sure. Yeah. And Brett touched on this, but it will be interesting to watch. It's an aside. Commodities like gold, they're priced in US dollars, for example. Like the US dollar continues to weaken. You kind of have to measure if it is a positive move in commodities in other currencies to really see how significant the move actually is, because everything's priced in US dollars, all commodities too. So, and it's interesting to just watch that. But definitely, it looks like Donald is paying a little more attention to the bond rather than the stock market move. So we'll watch that going forward. All right, I think we're good on that section, right? Good. I'm going to share my screen. We just completed our webinars for the spring of this year, and I'm going to share it. Okay, I'm going to go into a segment from our recent webinar, which you can get on demand today. We're going to talk about something we just introduced in this series of webinars, the orphan stock opportunity, essentially defining what is an orphan stock, how do you identify one, unique opportunities, and I'll provide an example as well. So I'm going to start off just defining that. What are orphan stocks? These are stocks, often small caps, that have been ignored by the investment community. As a result, may be trading at low valuations measured against their current or future prospects. We consider them higher risk, estimated to be 50 to 100% plus undervalued to compensate for this risk. So a minimum of undervalued 50%. That is a significant opportunity for gains if properly identified, and we're going to show some examples, I will today, from the past. So again, continuing on what is an orphan stock, well, these are extremely rare. We find about 2 to 5 annually after researching 5,000 plus stocks. In theory, the markets are all about efficiency, so a stock trading at, say, a 50% discount to its intrinsic value is definitely an anomaly. That is what we are trying to identify here. Orphan stocks have the potential to provide an element of higher risk growth that can be lacking in the average Canadian stock portfolio. So why does a stock become orphaned? Well, there are a number of reasons why a stock can become orphaned, but chief among them would be a lack of value creation from a shareholder perspective. Over the long term, I would say fundamentals are like gravity. If your stock creates consistent per share cash flow, often per share. Free cash flow, the stock price tends to stick to it like glue and rise over time. This is shareholder value creation 101. If the business of the stock you own does not create shareholder value long term, this is what I put on the screen here, by committing a number of what we call Keystone's stock sins listed here. That would include possessing no revenue or limited revenue, limited to no historic profits, weak margins, limited or negative growth per share, or just a poor business structure. Basically, these sins, stocks that have to do these things, essentially the antithesis of what we are looking for in a great long-term stock. Now, if a stock continuously does these things or performs these symptoms or has these symptoms over the long term, it can become orphaned or ignored by the market. Now, what would change a floundering business into an orphan opportunity? Well, a fundamental change in the business that really dramatically alters the company's profitability equation, a catalyst that brings about change through a spike in profitability, which is what ultimately drives stock prices. So how do we identify orphan stock opportunities? Well, there's no magic button or simple formula to help you discover these market anomalies. Your best weapon is brute force and volume. We come across, say, 2 to 5 of these opportunities annually, like I said, from looking at thousands of companies. But how? How do we look at these and how do we identify these orphan opportunities? You want to study the disclosures, conference calls, presentations, financial statements, conduct investigative interviews when potential catalysts present themselves of thousands of public companies, essentially to identify these anomalies before they are broadly identified. What we want to do is exploit the inefficiencies at the less followed end of the market. What is the process here? Well, once we identify a potential orphan stock opportunity, often we will wait until the catalyst takes hold to confirm our thesis, awaiting the release of at least one set of quarterly financial results before we step up and buy. This confirmation helps allay some of the execution risk and helps prevent becoming stuck in an investment concept that continues to suffer from failure to launch. While one may think the release of a strong quarter would immediately become priced into the stock, in most cases, an orphan stock by definition has little in the way of a following, and therefore the initial stages of the catalyst opportunity are often acted upon by no investor of consequence. The de-risking gain from the confirmation most often outweighs a slightly higher entry point and the downside of moving too early and becoming stuck in an illiquid stock that does not deliver on the potential catalyst. Once confirmed, however, we can act swiftly. We are ready with a buy recommendation immediately, which includes a buy range, rationale, and potential time frame for investment. Now, for proof of concept in reference to orphan stock opportunities, I present NTG Clarity, NCI, and the TSX Venture. This is a digital transformation business providing telecommunications, engineering, information technology, networking, and related software solutions to clients in the enterprise, telecom, utility, financial, IT, and government sectors. 95% of the revenues come from Saudi Arabia with no exposure to tariffs at present. The company was recommended in July of 2024. The recommendation price, as we can see here, 78 cents. Now I'll talk about its current fundamentals. I did later in the presentation, but as a case study today, we look at the business ahead of our recommendation just 9 months ago. Why at that time was it orphaned? What the opportunity was and how it has performed since. So why was NTG Clarity orphaned or ignored by the market? Well, for 9 years, between 2014 and 2022, NGD failed to produce anything close to consistent growth. 2014 revenues were $15.5 million, and by 2022, the company had grown revenues just marginally to $17.7 million, with a low of $7.9 million in 2020. Profitability and margins were weak, with more years producing a net loss than income. The profile was not that of a company that should attract investor attention. The stock was orphaned, suffering from low volumes and rightfully so a lack of investor interest. So fast forward 2 years, the catalyst appears to have taken hold, powered by a promised $1.3 trillion in investments in technology by the Kingdom of Saudi Arabia and a massive digital transportation. NTG had posted significant growth, backed by a low-cost labor force in Egypt, introduced strong growth guidance for 2024, backed by a record backlog. And we received confirmation in the form of a breakthrough quarter, 6 cents in earnings delivered in EPS in the company's Q1 2024, up from under a cent in Q1 2023, higher margins, higher EPS, and we had part of our confirmation. Now let's look at the fundamental value and growth equation that led us to believe NTG Clarity was an orphan stock as a good case study here. So in July of 2024, the stock traded around 78 cents. Now, based on management's guidance, our initial earnings estimate was in the range of around 13 cents. Based on this, the forward PE was in the range of 6. Now, our fair value was based on a low multiple of 10 times our 2025 initial estimate, about $1.30 at that stage, a 68% potential return, falling into our return requirement for a higher risk orphan stock. Shortly after, we issued a buy report at 78 cents. Now, in less than 10 months since, the stock has then posted 2 more record quarters and it has jumped 133%. Currently trades anywhere from $1.65 to $1.80 in that range. And we have increased our 2024 and 2025 estimates based on the current record backlog. So that gives you a good idea of the strong potential gains that we can deliver investing in this special class of small cap stocks. Now, in the full presentation, we also went on to introduce a company that we believe right now is an excellent orphan stock opportunity.
And you end it with the teaser.
Oh, always. I'm a bit of a tease. That's what they call me, right? I know, it's true.
Yeah, but people can access the DIY on demand and get the name of that
they
stock.
Can. I heard they can. Go to our website. Yeah, no, and we talked about it at the start. I mean, the company we're looking at now, that essentially in January of this year, I think nobody was paying attention to that company. They're benefiting from the strong uptick in terms of the price of gold, and we thought they were going to earn 20 cents per share, and at the start of this year, they were trading well under $1. So you're buying them 5 times. A typical, it is. We don't find a lot of these, but that is an orphan stock opportunity, and you can see NTG has more than doubled over the past year, which is great to see.
Yeah, no, I was just going to say we've when we do find them, they're across industries. It's not just one set industry. People will always think, oh, you need to look here, X, Y, or Z, whatever bias they have towards. They are widespread, and that's the difficult in finding them. Is you need to realize things will be overlooked, every little nook and cranny, but it's not one set area. It's not just whatever technology in NCI's case.
Yes, we wish it was. You could just look in one area, technology, or all gold stocks, or all oil, or all real estate related REITs, or something to do with that. But no, we are, and all of our analysis is sector agnostic. We look across sectors, but you're leaving no stone unturned. I mean, you literally have to look up. I mean, some of them, whether it's just obscure name, no profitability, and then broke through. I mean, these companies that have been around for decades, and then suddenly there's something that changes the business. Then you've also got to be careful, because on the flip side, you see a business that might have one quarter that is just an anomaly because of market conditions that aren't repeatable, right? So, and that's what you got to be careful about. I mean, we saw that sometimes during the pandemic. There were some companies, like there were hand sanitizer related companies. We looked at one company looked tremendously strong at one point, and it looked like, okay, well, wow, this is trading at reasonable valuations, but that was a one-time event that wasn't repeatable, and the stock fell off a cliff after that. So you had to be aware of those things in that period. You got to be aware of what's going on in the market. Is it sustainable?
What I would say as well is just like, a screener, a stock screener isn't going to pick these things up. Like we are going through the financial statements of all these companies, and they divested a piece of their business. Now they're expecting profitability or whatnot. And even like that hand sanitizer company that Ryan's teasing, we were considering recommending it. It had significant net cash on the balance sheet, huge cash balance. But we didn't end up recommending it. The stock ended up pulling back. And even I remember when we were looking at it, Ryan was saying to me, this could potentially be a takeover target just because of the beautiful balance sheet. And, I believe the stock did pull back, kind of following that pandemic hype with hand sanitizer. But, the stock did end up getting bought out. eventually. Again,
probably got bought
we're not
for the
going to
manufacturing facilities, to be honest. Like,
well,
and
well,
the cash
and exactly.
balance sheet. Yeah.
Mm-hmm.
Yeah.
But yeah, that's the thing. It's always, you always just got to be looking for these little opportunities out there. And, although we might not, recommend that one, like the hand sanitizer one, it's on our radar. We're monitoring it.
Yeah. And typically, like, the best business you want to buy is the one that you can see consistent long-term growth in, or, over a 5, 10, 15, 20, 30-year period. That's what you look for. If we're doing a ton of research and we can come up with these little anomalies that may be trading, at a 50% discount to intrinsic value, we can add that too. It's certainly higher risk. These type of companies are higher risk, and we have to note that anytime we make a recommendation in these of these types of stocks. But they come in all forms and all across businesses, and there are unique reasons why a stock may become orphaned. But we're always looking, and if we can find one or two a year that have that discount to their, what we'd say, their intrinsic value, and have potential for significant upside, it's something you can add to your portfolio. Certainly, we want to focus more on the long-term cash-generating great businesses, but this is a little element that we kind of added to our webinar as just to show investors that there are other types of investments that you can look at in the markets that we can find that are probably priced below where they should be fundamentally. Okay, and we want to move on. I think Aaron's looking at a leader in the defense segment space, Karman Space and Defense, right? KRMN on the New York Stock Exchange.
Karman Holdings is the name of this company. Yeah, so Karman Holdings is the name of this company. It's an interesting name that actually just started trading publicly. So they're in the space and defense space. They design and manufacture mission-critical aerospace systems serving the defense and space sectors with propulsion, payload, and aerodynamic technologies. So they just started trading. They just did their IPO in February of this year, actually, February 25th. IPO price of $22, currently trading today at $32. And it is a $4.3 billion market cap company. So very new entrant on the market. Not much track record. What they call themselves, they're a leading IP-driven supplier to contractors in 3 high-priority end markets. So this includes hypersonics and strategic missile defense, like propulsion systems, tactical missile and integrated defense systems, and also space and launch, like payload protection and deployment systems. So they're fairly diversified amongst those 3 end markets. And they are present in a wide range, over 100 different funded space programs. So they have clients including Starlink, U.S. government, and essentially most of the main players. Now, when we look at the company's 2024 financial results, good positive results. Of course, these were not reported with them as a public company. Essentially, 23% growth in revenue. Strong improvement in gross margin, 31% growth in operating income, and about 30% growth in adjusted EBITDA. We don't have any per share figures here because they weren't public at the time. But if you look at the historic performance that they're reporting going back to 2022, you can see a fairly good track record of growth over a couple of years here. 24% compound growth in revenue and 33% in adjusted EBITDA. And then looking forward to 2025, in terms of guidance, they're expecting about 24% growth in revenue at their midpoint and 27% growth in adjusted EBITDA. Now, in terms of just the overall growth, very impressive what they're able to produce here. But we really haven't had a chance to see this company produce on a per share basis as a public company. What we can do is look at analyst earnings estimates. So for the current year, 38 cents at the midpoint. That's almost a 90 times price to earnings valuation. And then going into next year, they're expected to generate at the midpoint of analyst estimates, 47% EPS growth, bringing them to 56 cents per share, still about a 60 times earnings multiple. Another thing that is somewhat concerning when I look at the company is just the balance sheet. I wouldn't say that they're over leveraged at this point, but they are fully leveraged. They have total debt and leases of about $450 million, about $4 million in cash. And then if we were to go off of their guidance for the current year, that would be a net debt to EBITDA multiple of 3.2 times. So normally we would like to see this number below 3, ideally below 2. So where it's at right now is more or less pushing the boundary of what we would consider to be appropriate leverage, but not a lot of flexibility to increase it from here. So when I'm looking at this company, it's obviously it's a very interesting business. The areas that it's in right now are exciting, and there's certainly a lot of growth opportunity in both those spaces. Space obviously is a huge growth opportunity longer term. Defense, a lot of money going into this space now, just given the geopolitics of the situation. So it's unique in the fact that it's a smaller cap company, high growth, profitable in these areas. So we like that. The balance sheet, we would like to see less leverage on the balance sheet. It does have a lack of track record in the public markets, given that it just started trading in February. And we would consider the valuation be expensive, even based on next year's expected earnings. It's about 60 times, a 60-time multiple. So while we think it's an interesting company with good fundamentals overall, our conclusion is that we wouldn't be buyers of it right now, mostly due to valuation and just the lack of track record. But it's something that we'd monitor. And if we did have an opportunity to enter at a more attractive price, then we'd consider doing it.
Yeah, I would just say it looks expensive right now, especially fully leveraged, going forward. So even if we're looking on a forward basis, it looks expensive. If it keeps growing.
Yeah, I mean, if we were looking at this and it was a net cash situation, giving it a lot of flexibility to.
But yeah, and I wouldn't be surprised if the debt level was why they IPO'd partially, at least, because they did reduce their leverage. They raised 173 million, so that would have reduced their leverage a bit. And yeah, they refinanced their credit facility as well. So they're obviously looking towards the balance sheet when it comes to that sort of stuff. It's not the greatest position, and not surprising that they need to raise money in some sort of way, and they probably just saw the IPO as opportune timing.
No, I mean, if they were sitting there with more resources on the balance sheet than that growth, if there were opportunities for a step change in growth, like a big acquisition or a big contract, we'd have more confidence that they'd be able to pursue it then without having to resort to debt or share issues. But although issuing shares right now might not be a bad idea if they're getting almost 90 times earnings for them.
All right, excellent. Let's move on to our final Your Stock, Our Take, ADF Group, DRX. Brennan has looked at this company. We have interviewed management in the past. The stock dropped significantly last week after its fiscal year 2025 results came out and its 2026 outlook. So, Brennan, why don't you give us a summary on what's going on with the business?
This is sort of a dog / Your Stock, Our Take on ADF Group, as it has been a very popular request over the past couple of months and even years. But following its recent drop after its fiscal year 2025 results announced last week, I thought I would give it a little bit of an update on the podcast. So ADF Group Inc, DRX on the TSX, currently trading at a price of about $5.40, a market cap of about 164 million, and a dividend yield of about 0.8%. So they are a North American leader in the design and engineering of connections, fabrication, including the application of industrial coatings and installation of complex steel structures for the non-residential infrastructure sector. And as of Q3 2025, so they just reported Q4 of 2025, but as of Q3 of 2025, management noted that its Canadian facility in Montreal is at about 70 to 75% capacity, and its US facility in Great Falls is at about 65 to 70% capacity. Now, the fabrication shop in Canada can do approximately 100 to 120 tons per year, while the US fabrication shop produces approximately 25 to 35 tons per year. Now, the stock has had a strong run since the beginning of 2023, driven by strong financial results. But Brett covered the stock on the podcast in October of 2024 and highlighted our concerns with the business continuing its strong financial trajectory within a cyclical industry. And since then, we got several comments with viewers indicating they were adding on the pullback. I then covered ADF Group again in January of this year, with essentially the same conclusion as Brett. And this was after we wrote up a monitor report for clients in our Canadian cash-rich profitable small cap research report released in late December of last year. But again, I noted in that report that there were headwinds with the business going into fiscal year 2026, which kept us and clients on the sidelines. And following the company's Q4 2025 results posted last week, the stock is down over 30%. So first of all, I'm glad that we conducted our due diligence, as despite the stock looking cheap on a trailing basis, we remained hesitant to recommend the business to our clients, given some uncertainty and margin headwinds. Now, looking at the recent quarter of Q4 2025, ended January 31st of 2025, revenue declined 12% to $77.4 million. Adjusted EBITDA for the quarter was $19.2 million, or a margin of 24%, which is up 24% from the same period in 2024. Net income declined 13% to $9.1 million, or 31 cents per share, compared to Q4 of 2025. 2024. And the balance sheet remains in a net cash position of $14.4 million, which is down from about $19.1 million following Q3 of 2025 when we last covered it on the pod. And that equates to a net cash position, or net cash per share, of about 40 cents per share. So overall, the business's fundamentals remain in decent shape. But looking a little longer term at how the business has performed for fiscal year 2024, gross margin, for fiscal year 2025, gross margin was 32% and net margin was 17%. But again, keep in mind, ADF Group is a contract-driven business, and over the long run, margins have been cyclical, which management equates the recent margin expansion to about a third coming from automation investments coming online at its Canadian facility, about a third absorption of fixed costs given higher volumes, and about a third from project pricing benefits. So margins are certainly at a historical high over the past decade. And looking at their backlog, order backlog totaled $293 million as of January 31st, 2025. But the bar chart that I have up on the screen actually includes the recent $120 million contract announced in February, which provides backlog of about $413 million and compares to about $510 million for the prior year period. So it is down a bit. Now, despite the decent financial results, the kicker here for why the stock went down was due to management's outlook, as they indicated, although we announced $120 million in new contracts at the very beginning of the current fiscal year, the uncertainty caused by the imposition of U.S. tariffs is delaying the conclusion of new commercial agreements. And in this context, we are compelled to analyze certain contingency measures, including the implementation of the work sharing program at our plant located in Terrebonne, Quebec. In this sense, we can already confirm that revenues for the fiscal year ending January 31st, 2025 or 2026 will be down, mainly in the first quarters, and that our margins will also be affected by the direct and indirect impact of U.S. tariffs. So prior to this, management believed that revenue would grow in fiscal year 2026, but they were working against tough comparable margins, believing that gross margin dollars would remain flat year over year. But it appears that this has now changed, and gross margin dollars will also be down in fiscal year 2026. So to conclude here on ADF Group, ADF Group has performed well over the past 5 years, growing backlog to $400 million in fiscal year 2025 from about $200 million in fiscal year 2019. And they expanded gross and net margins from about 8% and negative 0.5% respectively to about 32% and 17% respectively in fiscal year 2025. Now, there is cyclical risk, and a majority of ADF's revenues come from the U.S., about greater than 85%. Therefore, U.S. and Canadian trade relations, such as tariffs imposed on Canadian goods, can impact the company's demand and profit margins, as announced by management after their Q4 2025 results. Now, fundamentally, the business is in decent shape. with a cash-rich balance sheet, backlog elevated, and the business remains cheap on trailing numbers. Again, that's trailing numbers with a price to earnings multiple of under 3 times and an enterprise value to adjusted EBITDA multiple of under 2 times. But again, this is in the face of near-term tariff uncertainties, which appear to be materializing, as well as tough comparable margins and overall business cycle risk. Now, when we spoke with management following the Q3 2025 results, they indicated that gross margin dollars would likely remain flat year over year in 2026, with increased revenue but lower margins. But with the new outlook following the Q4 2025 results, it appears the headwinds are larger than they originally anticipated, and 2026 will be a difficult year, which has made the stock our dog of the week.
Yes, they're very much right in the center of all of the tariff dispute with their with the focus of their business. So it's just one of those names where just the uncertainty is high, and you're looking at that 3 times price to earnings multiple. While that looks cheap, that's based off of trailing earnings, really. So it's if they could be in a situation once their gross margins go down, below 12-10%, they're not making money anymore, right?
Yeah.
Yeah, I mean, I was looking
and
at
that's why we've stayed on the sidelines.
Yeah, I was just looking at a recent research report, which I would call a friendly research report to the company, and they cut their target price from $23 to $9. So significant drop. Again, we think we think the company has done a good job growing its revenue, growing the backlog. I think Brennan touched on it. One of our hesitancies on going forward, even though the numbers looked good on a trailing basis, we from our research and from talking to management, even without a tariff situation, the contracts were going to have a lower margin in this year than we had last year. So even if a stock looks cheap, generally speaking, if you're looking at lower EPS per share or cash flow per share in the next year or in the next couple of years, it's likely not the best time to buy if you're not going to be growing those earnings and growing that cash flow on a per share basis. It just doesn't make a lot of sense. So that's what kept us on the sidelines. We're glad we did. Perhaps we revisit. The other thing, and Brennan mentioned this as well, is this company was at a historical high margin base where historically the business is cyclical. And despite things looking tremendously strong, say 6-8 months ago, there is a definite chance in a slowdown that everything isn't perfect in terms of margins, and you're buying pricing imperfection to where it was maybe at $17. So and certainly even when it came down to 12, 10 below 10, then we were getting into a tariff situation, and we already had thought without that margins would be lower or EPS would be lower. We stay on the sidelines. So that's kind of part of our process, looking into why we did not recommend ADF. Not a terrible company by any means at all. All right, is that it for the podcast this week? I think we're good. Okay, well, if you are watching this on YouTube right now, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to thank you. Profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.